Hello and good morning, everyone.
Hello.
Good day. Yeah. So, my name is Yasser, and I'm your tutor for today's session, business taxation. And today's topic is calculate taxable income, corporation tax, and prepared corporation tax return. Uh, you might see, that few things same as yesterday. So by end of this lecture, I hope you will have a strong knowledge of the key issues, key taxes in the UK, and have they applied to different situations. So I hope you will be able to analyze taxable income, corporation tax, and prepare tax returns as well. Uh, can you hear me and can you see my screen? Any issues, anyone?
No. Yeah, I can see your screen. Yeah.
You, Rikita, Harriet.
Yeah, I can see your screen. I can hear you well too.
Okay. So, you are practicing accounting, Harriet?
Yes, I'm practicing accounting. Yeah.
Okay, in UK. Okay,
Yes.
good one. Have you done any qualification before, like AAT, CA, or something else?
No, I did at uni.
Okay, you
Yes.
done like a bachelor or something, accounting and finance.
Yeah, I did accounting and finance,
Okay,
BA, then I did my master's in finance. Yeah.
okay, so you're gonna get basically working towards license. Okay, IFA.
Yes.
Okay, that's good one. That's really good decisions. Okay. Okay, so let's get started. Please let me know if you have any issues like, if you can't see my screen or voice during my session or any other question you can ask, okay?
Okay.
So indicative content define the terms, period of accounts, accounting period, financial year, taxable total, profit, arguments profit, when accounting period starts and ends, expenditures allowable in calculating trading profit, uh, plant and machinery capital allowance computations, property business income, relief of property business losses, interest under loan relationship rules, chargeable gains, qualifying charitable payment, trading off relief, and calculating corporation tax payable, penalties for late returns, non-payment of tax. So, many things we discussed yesterday as well. Uh, okay, I just yeah. Right, UK tax system. Any comments or any one can explain? Rakida, we discussed yesterday. Any comments?
Everything is clear in this part. The
Yeah,
direct tax, which is the income tax, the corporation tax, the chargeable gains, and then the indirect tax, which is the VAT.
yeah, that's correct. So, UK tax system, several purposes, including funding government, expenditures, uh, and promoting social objectives. In terms of structures, tax can be categorized in two main types, the direct and indirect taxes. So as we discussed yesterday, direct taxes are levied directly on individuals or businesses, such as income tax and corporation tax. Uh, what do you think about, Harriet, indirect taxes?
And example is a VAT.
Yes, that's correct. You're right. Absolutely correct. Indirect taxes, uh, uh, on the other hand, are imposed on goods and services such as VAT, value add taxes, excise duties. Uh, So HM and revenue is the government body responsible for administrating the UK's tax system, ensuring compliance with tax laws and collecting taxes onto the government. Income tax, again, as I said, we discussed yesterday about, basic rates depending on your income level. For individuals earning between 1 and 37,500, the basic rate is 20%. And for individuals, it's 7.5%. For those earning between over 37,500, one and £150,000, the rates increases to 40% for income and 32.5 for dividends beyond 150. The additional rate applies, which is 45% for income and 38.1% for dividends. Okay.
Okay.
So basically, this data is based on I believe so 2020. Okay.
Okay.
Okay. So, and I don't think so there's any major changes or things like that. So beyond 150,000, the additional rate applies, which is 45% for income and 38.1% for dividends. So next is a personal allowance. Everyone is entitled to a certain amount of income that they don't have to pay tax on. For the current year, the personal allowance is 12,500. Additionally, there is a transferable amount of 1250 for some individuals. Then which is very important thing we discussed yesterday, residential status. You got any idea about Harriet residential status?
Yeah, so it depends on how long the person has been working here and
Yes.
how long he's been
Welcome,
staying here.
Petro. Hello, Jana Petro. Hi.
Hello.
Hi, how are you? Welcome. Welcome.
Thank you. I'm sorry for the delay, but I
No,
was
no, no,
having
no. That's
trouble.
fine. We just start. That's fine. Absolutely fine. There's no issue at all. So you are just quickly introduce yourself.
Okay. I am Juliana. I work for Devonport's accountancy office. I have just submitted the assurance assignment. Now this is my next.
Okay.
Rakida and I, we work together. We are colleagues.
Okay. Oh, okay. That's fine. So you have, you got any previous qualification like bachelor degree or master's or any other certification?
I have studied for business administration in Tirana. This is my bachelor degree. While I have studied my master degrees in marketing, in fact.
Okay.
But I have years that I work in accountancy.
Okay. So we were just talking about residential residence status. Residence status is very important in determining tax obligations. Individuals who have been previously resident in the UK may be automatically considered not resident if they have no ties in the UK. Conversely, they may be considered resident based on the number of ties they have to the UK, the child benefit. Okay, so here you can see that less than 16 days and 16 to 45 days, 46 to 90 days, and over up to 120, up to 180. And if anyone stays 180, this is a main part of, resident status, 183 or more, automatically resident, automatically, residents. So child benefit income tax, child benefit income charge, if your income falls between £50,000 and £60,000, you will incur a tax charges on child benefit received. This charge amounts to 1% of the child benefit for every 100% of income over £50,000. Car benefit, same, I think so. Who was here yesterday? Rakida. Okay. So Rakida, this is the same as yesterday. You know that, you know. So
Yeah.
yeah, the
We just
percent. Yeah. Go on.
the rules for the tax. Yeah.
Yeah. So percentage rates for petrol cars and diesel cars for the RDE2 standards are determined based on CO emission. For car emitting 50 grams per kilometer or less, the percentage rate is 16%. Emission ranging 15 to 51 to 75 gram per kilometer, it is 19%. While for emission between 76 and 94 grams per kilometer, it is 22%. A car emitting 95 grams per kilometer or more have a percentage rate of 23%. Moving on, car fuel benefits, company van benefits, individual saving accounts, and property income. So car fuel benefits, the base figure for calculation is £24,100. So this is used to determine the taxable benefit of having access to company provided fuel for private use. So for company van benefits, the scale charge is set to at 3,430 pound, and the van fuel benefit is 655 pounds. ISA or individual saving accounts have an overall investment limit of 20,000 pounds, providing individuals with a tax efficient way to save or invest their money. In property income, a basic rate restriction applies to 75% of finance cost related to residential properties, impacting tax calculations for property owners. Pension scheme limits. When it comes to pension scheme limits, there is an annual allowance, a minimum allowance, and an income limit. So the maximum contribution that qualifies for tax relief without any earning is £3,600. For approved mileage allowance for cars, there are set rate 45p per miles for up to 10,000 miles, 25p per mile for mileage exceeding 10,000 miles. And then lastly, capital allowance dictate rates of allowance for different assets. For plant and machinery, the main pool allowance is 18%, while for the special rate pool A, it is 6%. So for motor cars, the rate vary based on CO emission, again, ranging from 100% from new cars with emission up to 50 gram per kilometer, or 6% for cars with emission over 110 gram per kilometer. Annual investment allowance. This allowance allows businesses to deduct the full value of qualifying expenditures on assets from their taxable profits. So the rate of allowance is 100%, meaning businesses can deduct the entire cost of eligible assets up to limit of 100,000 pound. 1 million, sorry, 1 million pounds. So moving on the cash basis accounting, this method allows small businesses to calculate their taxable profits based on money in and out of their businesses rather than using traditional accounting methods. The revenue limit for using cash basis accounting is 150,000 pounds. Corporation tax. Yeah, corporation tax, which is the tax applies on the profit of companies. For the financial years 2019, the corporation tax rate is 10%, the applies to profit up to £150,000. Value-added tax is a consumptions tax, applies on goods and services. The standard rate of VAT is 20%. So there are registration and deregistration limit for VAT, which are £85,000 and £83,000 for deregistrations. Inheritance taxes. Inheritance tax is a tax on the estate, the property, money, and possessions of someone who has died. The nil rate based is £325,000, and there is a residential nil rate of £150,000. The rate of tax on the excess over the nil rate band is 20% for lifetime gifts and 40% for death. Can you hear my voice, and can you guys see my screen? No issues?
Yes, it's okay.
Okay, that's fine. Capital gain tax is tax on the profit made from selling certain assets. The normal rate of capital gain tax are 10% for basic rate taxpayers and 20% for higher rate taxpayer. For residential property, the rate are 18 and 28% respectively. National insurance contributions. National insurance contributions are payment made by employee and employers to fund state benefits. Basically, we discussed all of these yesterday as well, so it's the same. I think so. Who was here? Radhika, Rakida. Sorry, you might knows everything about.
Yeah, I remember.
Yeah. So, national insurance contributions are payment made by employer and employees to fund rate benefits. Class 1 contribution rate is 12% with a profit threshold of 8,632 pounds per year for employees and a rate of 38.8% for employers on earning above £65,001 per year. I think so. I'm not sure, but I heard that this is coming down to 10%. Anyone can confirm? Any one of you know about this one? This one is coming down to 10%.
Yes,
I
I can
don't.
confirm. They
Sorry?
have changed. Yes, I can confirm. They have changed to the new year.
Is it already changed or they are going to change?
I think it has already changed, and we apply with the new rates now.
Okay, so do you think that it will make a huge difference or what? What do you think as an accountant?
To the
Average, what do you think average impact on people wages or?
but now also the wages have increased as well, so I'm not sure. Maybe it's the same rate of increase, even in the tax, even in the wage rate. So
Okay.
yeah, it will. I think it will impact a little bit. It will affect even in the inflation. It will increase as well. So
Yeah,
this is how I see it.
I think so that 2% is not a big deal, but same time they are increasing some other taxes. You know that.
Yes.
So anyway, so interest rates are next is rates of interest. Interest rates are important in financial calculations. The assumed official interest rate is 2.5%, while the Bank of England rate is 0.50. Finally, there are standard penalties for tax errors, which may based on taxpayer behavior. For example, the maximum penalty for intentionally or and concealed error is 100%, while the minimum penalty for prompt disclosure of careless error is 15%. Right. Discuss tax laws and implications of unincorporated and incorporated businesses. Business that is incorporated, also known as corporation, is different from its owner and has its own right. In the other direction, a business owner and private businesses are the same things. The owner is responsible for all business results. Business that are not incorporated are usually run by one person or a team. Yeah. So the key difference between a business that is incorporated and that is not, it's how the owners run the business. An open business that does not protect its owners from the debts they might incur while running the business. However, a business that is incorporated does. So what is the business does not pay a bill? The debt has to be paid for by the investment in the business, not the personal property of the business owners. So it is the same when someone sues the business. When a business is incorporated, the company, not the owner, pays the damage. If the businesses loses a lawsuit, on the other hand, private businesses owners are responsible for any debts or claim that their company faces. Differing tax rates and deductions. Yes, business pays less in taxes than people do. Businesses that are established can also put off paying taxes until later. And if the company is small enough, it may be able to get a tax break from for that. Businesses that are incorporated have to file separate businesses tax return. Company owner who is not incorporated, on the other hand, can file one personal tax return. When it comes to taxes, an unincorporated business has some more freedom than an established business because it can claim personal tax credits. People who own private business can also use loses or lower their own income. So the cost of starting up and running a business, the articles of incorporations can be filed for a little as 25 pounds to start a company. But fees obviously vary from state to state. So when you add in the yearly filing fee for government and regulatory boards, the prices go up very quickly. So if business owners hire lawyers to help them set up and run their companies, they may also have to pay lots of money for a legal help. Incorporated businesses also have to pay ongoing maintenance costs, such as keeping more detailed records for budgeting, making financial statements, and filing federal and state tax returns. So the only times owners of sole partnership businesses usually have to pay for these things is when they need a legal help or tax help. Paperwork and ongoing filing. Basic filing quarterly and yearly reports with government and regulatory bodies. Businesses that are incorporated also have to hold, plan, and record yearly meetings for shareholders and the company itself. As a part of their preparation, a lot of paperwork may need to be, filled out and mailed out. So, including invitations and supporting papers, financial statements, and other reports that need to be sent to owners can be extra paperwork. Businesses that are not established usually don't have to worry about these things. Other ways they are different. Corporations, on the other hand, keep going even after an owner dies or when another investor buys the company. Companies that are not incorporated have to retitle and write new deeds in order to move property. Corporation must be open about what they do and report to shareholders, the government, and based on the industry, different commissions. People who own businesses that are not incorporated usually don't have to do this reporting, so they can keep their business actions, secret. Determine from given data capital tax payable and the chargeable gain subject to corporation tax. So basically, what does a gain arise? Gain arising occurs when there's a taxable sale or disposal of something valuable by someone who is subject to paying taxes on it. Chargeable disposals, this refers to any actions where is a taxable asset is sold, given away, or otherwise disposed of in a way that triggers tax obligations. Then chargeable assets, essentially this includes anything of value that could potentially result in a taxable gains when sold or disposed of. Exempt assets, there are type of property or investments that are not subject to taxation when sold or disposed of. Some examples include private motor vehicles, certain government securities, specific type of bonds, and investment in individual saving investments. Okay, chargeable gains. A company's chargeable gains are counted as any other income and are part of the incorporation tax bills. Businesses do not have to pay capital gain tax. Most of the time, the question will give the exact amount of the capital gain, but sometimes the candidate may have to figure it out. So all gains need to be added up. You need to take the total gains and subtract the capital, losses uh, to get the next payable gain. So this is done whether the losses are for the same period or from a previous period. Again, you can't get full marks if capital losses are taken out of the wrong income. Right, here is the residency test. All good, everyone? Any question? Can you see my screen, voice, everything is okay?
Yeah,
Yes.
everything is good.
Okay. So I'll quickly go through one by one. Automatic non-UK residency tests. If an individual spend less than 16 days in the UK during the tax year, or they spend 46 days or less in the UK and have not been in a UK resident for any of the past 3 years, or if they spend 91 days or less in the UK and work full time abroad, they then they are not considered residents of the UK for tax purposes. Previously, resident in the UK, if an individual was a UK resident in any of the last 3 years, they need to consider all 5 tests to determine their residency status. Automatic UK residence test, individual is automatically considered a UK resident if they spent 183 days, okay, or more in the UK during the tax year, have their only home in the UK or work full time in the UK. Also, a sufficient ties. Sufficient ties test. This ties consider various ties in an individual may have with the UK. These ties including having close family in the UK, such as spouse, civil partner, or minor child, using accommodation in the UK during the tax year, engaging in substantive work in the UK, and spending in certain number of days in the UK in the last 2 tax years. Not previously a resident in the UK. If an individual was not a UK resident in any of the last 3 years, they need to consider the first 4 tests to determine their residency status. So here is the example for like a trading profit. A fun factory limited provided by this following information for its accounting year. We will explain like a trading profit, the company's trading profit before considering any deductions or allowances amount to 900 and 69,000 pound and 200 pound. So non-trading interest, this includes any interest earned by the companies that not related to its primary business activation. So in this case, the companies earned 44,000 pound in non-trade interest. Property income, the company generated 64,000 pound in income from its rental properties after accounting for expenditures. Uh, total profit, uh, total profit adding up the trading profit, non-trading interest, and property income, we get the total profit of 177,200 pound, less qualifying charitable donations 28, and total taxable total profit is 149,000 pound and 200. So this is a taxable total profit. So here is a adjusted trading profit before capital allowances. This is basically the company's trading profit before accounting for any capital allowances or deduction if total is 1 million and 1,200 pound, less capital allowances 32,000 pound and 969,000 pound and 969,000 and 200 pound. Non-trade, yes. So capital allowances, the company claims the company claims 32,000 pound in capital allowances, which are deductions allowed by certain types of expenditure, such as equipment or machinery used in the business. Adjusting trading profit uh, after deducting the capital allowances from the adjusted trading profit, we get the final trading profit of 969,200 pound. Bank interest payable, accrued and paid to purchase rental property. This refers to the interest paid on the loan used to purchase a rental property. It amounts to 8,000 pound. Right. So donations to national charity, the companies made a charitable donation 28,000 pound. Dividend paid, company paid out 50,000 pound dividend. After considers all these factors, we calculate taxable total profit for the year, which amounts of 62,000 pound. The figure is arrived by subtracting the bank interest payable on the loan for the total rental property 44,000 pound from the adjusted trading profit 969,200 pound. Same, there is another example. In this example, we have Bogle Limited, a company that prepared accounts for a 15 months period ending on June 30, 2020. So if we quickly break down the information provided and calculate Bogel's limited taxable total profit for each accounting period, adjusted for tax purposes but before capital allowances, Bogle Limited earned £380,000 from its trading activities. They received £22,000 of bank interest for the year ending March 31st, 2020 and £20,000 for the year ending March 31st, 2021. They earned £10,000 for rental income, then chargeable gain of £16,000 from the disposal of an asset on June 1st, 2020. The company made a qualifying charitable donation of £24,000 on February 1st, 2020. Bogle Limited bought plant costing £25,000 for use in its trade on April 1st, 2019. So the balance brought forward on the pool was £20,000. So here, so £20,000. So calculation will be total profit for each accounting period here. If you see here for the year ending March 31st, 2020. So the brought forward balance of the tax written down value is in the main pool is £20,000. Company purchased plant costing 25,000 April 1st, 19, which qualifies for the annual investment allowance. So the plant cost is fully covered by the AIA, resulting in no addition to TWDW written down allowance. WDA is calculated at 18% of the written down value, resulting in a deduction of £3,600. So this leaves us with the carried forward written down value of £16,400. And here, I'll go through up to here. When you guys get time, you can see this one as well, okay? So Bogarts Limited total profit for each accounting period for the years earning 31st March 20 trading income adjusted for tax purposes but before capital allowances is 3,080 £380,000 bank interest. I will go here. Yeah. Right. So Bogle's taxable total profit for each accounting period for the year ending March 31st, 2020, Bogle's limited trading income adjusted for tax purposes but before capital allowances is £380,000. And then bank interest received on March 31st, 2020 for the year ending March 31st, 2020 amount to £22,000. Bank interest received on March 31st, 2021 for the year ending March 31st, 21 is £20,000. Rental income for the period is £10,000. The chargeable gain from the disposal of an asset on June 1st, 2020 is £16,000. And a qualifying chargeable donation of £24,000 was paid on February 2021. February 20. So here is also the corporation calculating adjusted profit for corporation tax purposes. This is a basically performer for corporation tax performer. You can see how it the calculations work for corporation tax loss performer. example one, if you see here, Cup Limited commenced to trade on April 2017. It has the following results. Trading profits 10,000, 120,000 year ended, and then 52,000. Non-trading interest year first, second, and third. Then again, chargeable gains nil, second, and nils qualifying. So show how the relief could be claimed as soon as possible. So basically, this calculation is here. Okay, year ended 31st March, and calculated adjusting profit for corporation tax purposes. The tax return says that Adam pays of the, here, these three calculation, and this is a conclusion calculations. Pays for the fiscal years 2019-20 is 45,000 pound. A pay for the fiscal year. He puts a total of 4,400 pounds into his own pension plan over the course of the year. Adam made a tax gain of 21,000 pounds when he sold an old tables on June 15, 2019. So B has made a trade profit of 60,000 pounds so far in the first years 2019. 2019, she made a gain of 19,800 pound when she sold an old vase on August 2019. So this gain had to be taxed from 2019 to 2020. Chester will get a pay of 43,000 £500 from the government. He sold a house on October 25, 2019, making a profit of £47,000 that had to be recop. Here is the calculation. So Adam, taxed income is 31,500 pound, which is found by taking 34,000 and taking away the 12,500 pound personal allowance. His basic rate tax band has gone up to 43,000 pound, 37,500 plus 5,500 pound, which is 4,500 times 100 divided by 80 for here is used, but only 11,500 pound of that 43,000 minus 31,500 pound is used for taxes. Adam made a taxable gain of 9,000 pound, which is 21,000 pound less than the yearly tax-free amount of 12,000 pound. So this means that Adam gains a completely within the unused basic tax basic rate tax band. Because of this, he owes 900 pound in capital gain tax, which is the same as 9,000 pound at a 10% rate. By subtracting 12,000 pound from her taxable income here. So B has used up all of her basic tax rate bands. Because of this, she needs to pay 1,500 and 1,560 pound in a capital gain tax on her taxable gains of 7,800 pound at 20%. 19,800 minus 12% is therefore is it's a 20%. When you subtract 12,000 pound, 12,500 pound from 12,500 pound from Chester's taxable income, you get 31,000 pounds. So this means that 6,500 pound, 37,500 pound minus 31,000 pound of his basic rate tax band is still not being used. Chester has to pay the following amount of capital tax, gain tax on his taxable gain of 35,000 pounds, means 47,000 pounds minus 12,000 pounds is therefore. So basically you can in detail you can calculate this whenever you get chance. You can go through unless you don't do by yourself, obviously. That in that way will be more understandable for you. Right here, property business income. Can you guys see my screen and hear my voice? Any issues?
No, no,
Yes.
Yeah,
Okay, so this includes property business income. This includes all money that comes in from renting out homes. Candidates should include any rent that has not been paid yet for the period. The actual date of payments does not matter because the rent is charged in the years that it's due. So this is because it has to be worked out using the accurate method. If you are an individuals, the calculation is the same. The only difference is the interest due is not a tax deductible cost because it is non-trade interest, which was talked about in the paragraphs before this one. If the calculations shows a loss of property, that loss must be taken out of the total profit of the same year before any charitable donations that can be deducted. So there is another way to use the loss of this method does not work. It can be carried over to the next year and used against the total income made before the qualified charity donation. So if the loss is taken out of the wrong place, like against the tax year income from the real estate business, the full grade will not be given. Dividends, any comments on dividends? Do you know what dividends are? Can you hear me, guys? Dividends.
yeah, dividends. It's the profit that is given to the shareholders by the end of the financial year.
Yeah,
They decide with a meeting that the shareholders have. They decide and they share the profit.
yeah, well done, Rakida. So also dividend owing should never be taken into account when figuring out how much tax is due because they are not tax deductible. You don't have to pay taxes on dividends that you get. So this is called franked investment income or FII. Dividends from companies that are not related to the business are grossed up by 100 divided by 19. So then this income is added to the total profit that are taxed, which makes the profit bigger. So the augmented profit or AP number tells us how much company tax to charge. When this amount is worked out, the tax rate is never taken into account. So we always have to figure out the argument profit to get the tax rate. But once we have that numbers, we have to make sure to apply that rate to the TTP, total taxable, profit. Trading losses again against total income, against future trading profit, extension against uh, chargeable gains. So any idea about what trading losses are? Anyone? So basically trading losses, these happens when the cost of running a business the higher than the money it makes. Okay. So it's a simple definitions when the cost of running a businesses are higher than the business money it makes. So a trade loss is when a business has when it spends more money than it makes.
Yeah, when the business spends more money that it generates revenue.
Yeah. So based on total income and treatment, how do we deal with these trading losses when it comes to taxes? one way to deal with them is to subtract them from your total income, either from the current tax year or the one before it. So in other words, if your businesses had a bad year, you can use that loss to lower the amount of income tax you have to pay on other forms of income like your salary or investments. So no limit or personal accounts. Uh, this is very important to know that this balance can't be limited in order to protect your personal loans. So this is the amount of money you can make before you have to pay taxes. You can use up a certain amount of your trade losses to lower your overall income in a given tax year, but only up to that amount. So maximum deductions from total income greater of £50,000 or 25% of adjustment total income. Adjustment total income is equal to total income minus gross profit. Maximum deductions applies to losses set against current year total income. Earlier years, if set against income other than profit of the same trade, does not apply to losses set against gains. So basically, you know, these are taken away from among extension against gains that can be charged. There's more tough. If you have tried everything else and nothing else works, you may be able to use your trade losses against chargeable gains for a longer time. So how it works in the current year, you can treat your trading losses as a capital losses. If you can't find any other way to offset them against your total income or future trading earnings, uh, position among capital loss, these are taken away after any capital losses that happened this year, but before any losses from previous year that were brought forwards. So there is a no maximum limit. It is important to keep in your mind that there is a no maximum limit on how trade losses can be used to offset chargeable gains. Opening years relief, trading losses, and terminal loss relief. Opening year relief, this relief comes into play when a business incurs losses during its first 4 years of operations. So now what happened here is that these initial losses can be offset against the total income of the previous 3 years following the first in, first out principle. Essentially, this means that losses from the earliest next tax years are set off first against income from the previous 3 years. However, there is a maximum restrictions applied just like ongoing loss relief. Terminal loss relief, terminal loss arising in final 12 months of trade carried back 3 tax years against trading profit. So basically, this relief applies to losses that occurs in the final 12 months of a business trade, including any overlap profit. What's interesting here is that these terminal losses can be carried back, meaning they can be offset against trading profit from the preceding 3 tax years. So this backward adjustment can help reduce the tax burden for the businesses in the final year of operation. Now, calculate corporation tax liabilities from given data. Here is the data. During the fiscal years 2018-19, Joe's income include a salary £43,000, saving income 2,000, dividend income 16,000. In the course of the year, he made a payment of £300 in interest, which was intended for the purpose of qualifying. Joe was subject to deduction of £6,230 in pay from his earning by his employer. So Joe is responsible for paying the following amount of income tax. Here is a calculation. So employee income, dividend income, saving income, interest paid, personal loans, taxable income. So this is a basically performer of corporation taxes. So in order to demonstrate to process of preparing a plant and machinery capital allowances, oh sorry, it's here plant and yeah, here is the calculation for this. So as I said, Joe was subject to deduction of £6,230 in paying from his earning by his employer. So Joe is responsible for paying the following amount of income tax: taxable income, non-saving, saving income, dividend income, and tax total. You can visit for demonstrate how to prepare a plant and machinery capital allowances. Whenever you get chance, you can visit this website for your further reading or for knowledge, and prepare a plant and machinery capital allowance computation. So you can visit this a link. So here is a Marion, and which page is this one? Yeah, Marion and Nancy both are two companies making the same products. So basically, record earning before depreciation in the financial years. Financial in their financial returns, a profit before depreciation of £400,000 has been recorded by Marion Limited, while Nancy Limited has likewise reported a profit of £400,000. So now when we take a look, depreciation, which is the process by which the value of assets decrease over time. So we see that Marion Limited has a depreciation expense of £30,000, while Nancy Limited has a depreciation expense is £50,000, which is slightly greater than Marion. So the accounting profit of each company are calculated by taking their respective earnings before depreciation and subtracting the amount of depreciation from that total. So if we compare the accounting profit of Nancy Limited to that Marion Limited, we find that Nancy Limited profit is £350,000. So let's think at a capital allowance and how they fit into the picture. Both Marion Limited and Nancy Limited are eligible to receive capital allowances totaling £40,000 for the pounds for the purpose of lowering their taxable profit. Businesses have the ability to claim capital allowances, which are deduction that can be claimed on specific type of capital expenditure such as machinery or equipment. Here in the previous companies that we made between Marion and Nancy Limited, we saw that both businesses reported earning profit in their financial records, and accounting profit of £370,000 has been recorded by Marion Limited. Obviously, minus £30,000 was for depreciation. But Nancy Limited reported a profit that is somewhat lower, is 350. So after that, we take into account the financial burden of depreciation that each organization has incurred. Marion Limited has reported a depreciation expense of £30,000, while Nancy Limited has reported a depreciation charge that is £50,000. So this offers us the total amount before any charges are made, and is obtained by adding the depreciation expenses to the accounting profit. Both Marion and Nancy Limited so contribute to this sum, which comes to £400,000. What qualifies as plant and machinery? You can only claim capital allowances if the assets qualify as a plant and machinery. So, despite the fact that there is no definite legal definition of plant and machinery, there are a number of significant considerations to take into account when deciding whether or not an asset meets the requirements. Degree of permanence, we need to take into consideration that the length of time that the asset is supposed to be maintained. It is something that will be present and functional for a considerable amount of time. Assuming this is the case, it is more likely to be categorized as plant and machinery. Information, the role of the asset is another essential component, and it is essential to have this information. Specifically, is it being utilized in the process of carrying out the business's activities or trade? Plant and machineries are more likely to be classified as asset if they are utilized in the day-to-day operations of the company, and play an important part in those operations. Uh, the following common example of plant, obviously, factory machinery, office furniture, office equipment, for example, computer, photocopiers, cars, vans, lorries, motorcycles, movable partitions, alterations to building to allow installation of plant. So alterations basically such as these could involve in improvement to the structure or the installation of new concentrations of utilities. So capital allowance pro forma, again, computation of companies. Here we are going to investigate the process of which business determine their capital allowance. It is important to take into consideration the general pool, the special rate pool, and the short life asset pool. These are three primary, pools. So AIA, annual investment allowances, and the first year's allowances, FYA. What are those two type of allowances? The fact that these enable business to claim complete deductions from categories of assets in the same year that they are purchased make them a significant elements. When it comes to the journal pool, we begin with the tax written down value. Here, can you see that brought forward written down value that was brought forward from the previous period. So next we include any new assets that do not meet the requirements for AIA or FYA, such as automobiles. We also include assets that are eligible for AIA, such as machinery and plant, among other things. On the other hand, we must keep in mind that we must not go beyond the maximum AIA annual investment allowance permitted. So in the event that the AIA allowances exceed in any way, the money is transferred into the common pool. When assets are sold, we deduct the amount that is below the lower of the sales proceeds or the cost of the items. Are you okay, guy? Hello?
Yes, yes, everything looks fine till
I
now.
know that
Yeah.
this is a bit boring and a little bit long, but obviously, you know, uh, so this is a performer for companies continued capital allowance again from this. Uh, Here we'll go through here this page abbreviations. TWDA tax written down value is the abbreviation for this term. So when allowances have been subtracted from the value of an assets, this is the value that is considered for tax reasons. AIA, annual investment allowance, is this is stands for the annual investment allowance, which is features that enables businesses to deduct the complete cost of specific assets from their taxable income. First year allowance, or FYA, refers to a tax deductions that enables businesses to deduct the total cost of specific assets in the year that they are purchased. Uh, then WDA, writing down allowances, refers to financial tool that enables businesses to deduct a specific purchasing or percentage of the value of an asset on an annual basis. So having a better understanding of these abbreviations will make it easier for you to navigate through the computation of the capital allowances. Any issues so far?
No.
You're not getting bored or any issues? You want me to carry on? Or I can divide this lecture into two if you are tired or any issues or.
No,
Okay,
okay.
okay, let's end up here today. Then because there are 20 more slides, so what I will do that I will carry on by next weekend. That will be easy for you to understanding. I know you are getting because there are 20 figures over here. Anyway, any questions so far? Any concerns? Any issues?
Sorry, can I ask you a question about the, can you hear me?
Yes, yes, I can hear. Who's
About the study materials. I have logged in Moodle.
yes.
So the study materials are just the ones here. This that is AAT, right?
What you mean you mean AAT?
Yes. I just want to know where we should base, which study material we should use for this assignment.
Have you seen these slides on your Moodle? This slide.
This slide, no. I
Yeah,
just
you will get my recording into your email through the email or Moodle. Okay, the one thing is. So another thing is you might have some books. There are not specific books for IFA or that like ATHE. So
I
this is
mean some references.
yeah, this is basically for references, but can't you see any books on your Moodle or learning management system?
Yes, I have seen some books, but I just wanted to know which one of these we should use to study.
Yeah, you can for reference you can see any books. Okay, so
Okay.
yeah, you can use basically you will go through your learning outcome material or your syllabus. Have you got syllabus, which is your current syllabus, which are your topics related to your subject? Okay.
Okay, then.
So you
So
only,
I can use all of them, and for the assignment, it's
yeah,
not.
for assignments, you can use any material for anywhere, from your learning management system, from websites, or from any other books, okay?
Okay, okay, then.
So what
Thank
will
you.
happen that this is our second lecture, and when we will finish, my fourth lecture is about assignment. Okay. So obviously this lecture I will, because this is a quite long lecture. I know, because yesterday was a quite long lecture. So what I will do that I will divide it into two, and next weekend, hopefully Sunday or next Saturday, I mean that weekend after, will be our last lecture about assignment discussion. Okay. So when we will discuss assignment, then you can see that, what to use or what not to use to complete your assignment. What is your exact, how to complete your assignment. But you have your syllabus in front of you. I mean that if you look at your, who's there, Radhika? Sorry, can you hear me?
Yes, yes, I can hear you.
Yeah, you got syllabus, what is learning outcome 1, learning outcome 2, learning outcome 3, and learning outcome 4.
Yeah.
So all learning outcome 1, for learning outcome 1 is your syllabus, then learning outcome 2, and then learning outcome 3. So you can use any book, any websites, or any wherever you can get, material you can use for to complete your assignment, or you can study. Okay.
Okay, then.
Yes.
So, like, let's say I give you example, like uh, uh, writing down allowance. So to study writing down allowance, you can use any book, whether it's from ACCA, AAT, or IFA, or you can use online material. You can read about writing down allowance. Okay, or capital allowance will be same everywhere. You can read anywhere about capital allowance. So basically, learning outcomes are basically for your guidance. Okay. So for your references, so you can study books from anywhere. It's a main concepts are same everywhere. Okay.
Okay, then.
Okay. So that's it for today. Or you guys, is it
Thank
okay?
you very much.
Oh, okay, that's fine, no problem. So I'll see you next Saturday, 12 o'clock for our third session. Okay.
Yes.
Thank you very
Okay.
much. And
All
by
right.
then,
Thank
if you
you.
have,
Thank you.
if you have any question by then, you can drop me an email at yasir@ukversity.co.uk. Okay. Thank you
Okay.
very much, and have a good weekend ahead. Okay.
You
Bye.
Thank
too.
you as
Bye.
well. Bye.